everybody, and welcome to another edition of Market Roundup for Saturday, March the 1st, our video blog of live trades, live analysis, and your way of tracking along with the markets for free and trading like a trade pro. All right, this week we're going to cover a lot of exciting information. We're going to start off with looking at some of the equity market developments on the S&P 500, talk about some of the political tensions from Ukraine and the Russian involvement in that situation, and also talk about some levels. Where could we be headed on the markets? And this rally for real? Is it for real? What's taking place? Who's it worrying? And is it aligned with the economic recovery? All right, as the economy rather struggles to recover, the markets are finding themselves at consistently new highs. All right, so what is going on with that disconnect? We're going to talk about that very briefly in today's session and explore that. All right, so first and foremost, let's get kickstarted with looking at the S&P 500. It's been a very rocky and indecisive weekend through here. If you just highlight this one area, what does this look like? It looks like a period of indecision, doesn't it? There was a battle between the bulls and the bears at a key level of the 1850 that on Thursday was finally won at a close higher by the bulls. All right, so that found us in a bullish territory in an up pattern. It closed above the previous resistance of this double top that played itself out really. And at the beginning of 2014, all through January, people were talking about retracement to start the year, and then that conversation switched to the C word, correction. All right, which correction's 10% plus to the downside of the previous trend. We didn't really get there. This represented about a 5% drop. So we went with the retracement. We got a recovery right after in the form of a V bottom. And there was one thing that concerned us at Trade Pro Academy that we openly talked about. And that was that 1850 level and how was it going to fare from the previous highs. All right, so we have 1, 2, and we had a 3 here. And this looked like even a rising wedge. And we know what happens with the rising wedge. If we get a bearish candle, bearish volume, well, that's some downside pressure that could have led to a trading range or a sideways pattern. All right, of course, we know that didn't happen as of Friday. The Thursday we got a close. We were lacking volume. We're right around the average. On Friday, we got some bullish volume that shows us there's some interest and some stability above the 1850 level. All right, we need buyers to sustain a trend. All right, if nobody's buying, who's going to push this trend higher? That's the question we ask. And here we are. We find ourselves at an all-time high at 1859.45 close, and it traded as high as 1867.92 on the SPX, which is the S&P 500. All right, 500 stocks in North America. So, in the United States rather, not just North America. So the question becomes, do we have enough momentum to sustain above 1850, or are the political tensions in Ukraine and around the globe and that economic weakness that has come to light in the past week, including Janet Yellen's own opinion, is that going to be something that pushes us lower? All right, and that's really the key question, because looking at this day, yes, it's a breakout above the high, but it's not a very decisive breakout. In fact, this candle right here is not quite a doji, but it could be looked at as a spinning top. All right, the key word here is top, because it occurs at a high, at a resistance. Are we at a resistance? Yes, we're at an all-time high resistance. All-time high always plays a key factor in giving resistance to the markets, so it could continue a downtrend. Okay, so that's the concern, that's the pressure. We know that Russia's confirmed now that the military's moved into Ukraine. They're giving us that confirmation, and that's against orders or a stern warning by President Obama saying, don't do this. And he didn't say, or else. Usually when you get a threat, it says, don't do this, or else I'm going to do the following. We didn't get that second part of the statement, so he just said there's going to be a strong consequence as a result of this action. Russia didn't care. They went in anyway, so this is going to be unfolding starting next week. It's going to be very interesting to see what happens. All right, this could cause some tension, could cause some political instability, and that could turn into volatility in the marketplace. Do we love volatility as traders? Absolutely, we do. Volatility is our game. All right, that's how we trade. But volatility is also risk, because we could see swings and whipsaws in the marketplace, and that's to be expected. So be very careful out there. There's a very worrisome undertone in the markets for the week to come. I want to show you something very quickly in terms of some of the economic releases we've gotten, courtesy of forexfactory.com, a site we often turn to for our news analysis. On Tuesday, February 25th at 10 a.m., we got consumer confidence. Why is consumer confidence important? Well, it makes up 70% plus, consumption does, 70% plus of the United States economy. All right, that was interesting. Speaking of that, look, 78.1, so it was lower consumer confidence than thought. Consumers are not confident about their money. Why? Well, because of unemployment. They don't have a job, all right? There's a lot of unemployment. Looking at the number of 6.5%, that's absolutely bogus. That excludes people that have left the workforce and that can't find a job that satisfies their needs. All right, so if you are somebody who is looking for a full-time job but has a current part-time job, you're not actually unemployment, but you're a discouraged worker. So you looking at some of the unemployment statistics, it's believed to be around 11% still. Consumer confidence is low because people don't have a job. Money isn't circulating into their pockets. All right, yet the markets are pushing to higher highs. So that's very interesting. New home sales, yes, they're up, but a lot of this is investor demand. If you look at some of the underlying numbers, it's all cash sales upfront by investors to rent out to people who can no longer afford a home. All right, core durable goods orders, that came up positive, which is good. And employment claims slightly higher. Nothing really to rave about. I mean, 10,000 is not that much, but the undertone is that 348,000 people listed and filed for unemployment the previous week. That's a big wow because it's higher than the expected 333. All right, Janet Yellen testified on Thursday. She stuck to pretty basic statements. She said pretty much nothing new except one thing that I picked out when she was questioned on the economy. She said she was concerned about recent weaknesses in the reporting that she's seen. All right, so they're still tapering. You remember they're cutting $10 billion from stimulus a month, and that's really going to be up for discussion. Are they going to continue that? Yes, she supported it openly, but the question becomes, are they going to unwind it to zero over the months, or are they going to some point going to say, hey, you know what, let's hold it here. It's currently at 75 billion. For March, it should be cut down to 65. We'll look at that as a topic of interest in the coming weeks. All right, preliminary GDP. This is huge in the United States. GDP is now only 2.4%, forecasted of 2.6. So growth rather slowing down in GDP, and that's after they adjusted the calculation to make it look rosier, to paint a rosier picture. All right, pending home sales, well, they're absolutely terrible. They're just staying above the zero mark, 0.1% from a forecast of 2.9. So pending home sales aren't doing that well either. All right, home sales not doing well. Unemployment is increasing based on the unemployment claims. GDP is lower. All right, so that sounds bad, doesn't it? Markets steaming and pushing to an all-time high. And this is what we're talking about, the elimination of the middle class. The people that work hard and more money going to that 1%, the top tier, the upper echelon of people who have the money and the wealth. All right, that's a little more political and really outside the bounds of technical analysis. So let's do some text on the S&P 500. Are we getting higher lows? We most certainly are. You can see that here in the chart. Are we getting higher highs? Well, absolutely. So for all intents and purposes, now we have a new higher high. We're still in an uptrend. We're still bullish. And this is the only direction that we could be taking. But some key levels to watch for in the upcoming week. Are we going to get an open that looks like this? If we do, we need to have volume. On Monday, it's going to be a key pivot level. We need to find strength if we're going to be bulls. Nice up candle that looks something like this on high volume. If we do not, if we get a combination of this, something that looks slightly bearish even, well, that's, you know what? That's a definition of a top. If it starts to look like this, guys, I would say we might be in for some bearishness. So keep an eye out for that. If we start plowing higher on volume, well, then you could ride that along. Okay, moving averages, they're still bullish, acting as strong support. Long-term moving averages also bullish. Momentum, however, has peaked, and it looks to have been turned based on stochastics. RSI still has some upside, so too does MACD. So I would say this is neutral. This isn't telling us that we're out of upside. In fact, there is some upside potential, so this could happen. Now here's a question. If it was to go up, well, how high can it go? And I'm going to show you how high and what tools we have to project that. Look at this. There's a resistance here from this 2009 channel. There's a support. This, ladies and gentlemen, is called a trading channel, a very powerful tool for measuring targets and entry points at the support. So how much upside do we have? Well, not that much. And what's happened at these levels? Well, something like this, as you can see in the past. So are we here? This is the big question mark. And believe me, it's not just you and I looking at this. It's every trader, every institution, every proprietary desk knows this level. So keep an eye out for it. Draw it on your charts and enjoy the day. All right, that's the S&P 500. Let's very quickly look at a good trading opportunity here on GLD. We know everyone's loving gold. It's been hammering higher from January 2014 or so, about 114 to now 127. Nice, right? It's starting to look up. starting to look good. It's broken this resistance trend line here around early February, but right now is the absolute worst time to buy it. Why? Here's the answer. We're not getting a higher high. All right, guys. As technical analysts for a long time, 10 plus years, I can tell you that the likelihood of the trade being profitable to the upside increases right here above this level. Anything before is a lot of high risk, low reward opportunities in the long run. If you trade before getting north of this previous high, while you have the opportunity to pay for it and damage your trading account balance. All right, just be very cautious on the ETF. 132 is the previous high. You want to see some closes above there. I know it looks good and cheap here, but if you get a close above and if you get some bullish volume, what you're getting is certainty. All right, you're getting a higher percentage probability trade for the same dollar amount of risk. Okay, so enjoy that trade. That's an opportunity above 130 to get 139. That's a $7 profit, and 151 is the next level. But keep in mind gold and the chart, and this is what it looks like on a weekly basis. All right, it's been bearish. We don't have a higher high. We have lower lows, in fact, just about, and lower highs right now. So it still looks bearish. Don't let this little bullish momentum fool you. And I only cover this in today's market roundup because I've been getting a lot of questions on this. And there you go. There's your answer. So for the week, don't trade gold. There's some better trading opportunities on the charts. If you guys want to find out what those opportunities are, I'm going to show you how to do that. Sign up for our website. Go to TradeProAcademy.com. All right. Register here. Sign up for it. You get 1 month free access to Market Analysis Live. What is MAL? It's a 60 to 90 minute. We usually go to about an hour and a half analysis of the markets in depth. We look at 10 to 15 stocks. We analyze them. We talk about trading opportunities for the upcoming week. All right, so we set up a trade, including a stop loss, target, what to trade, how to trade it. That's what we do. You get 4 weeks for free. This happens every Sunday. All right, Sundays at 8 p.m. to 9:30 p.m. Eastern Time. You can sign up today. You get 4 of those for free, absolutely free. All right, 320 minutes plus of information. Have a look at it. Our performance is about 80 to 100% annual, and we keep track of the results. We print and publish performance reports, and here we are for you. All right. You can also check out our blog. We feature a lot of stuff during the week and a lot of commentary charts. Have a visit, TradeProAcademy.com. Sign up today and get free access to Market Analysis Live for 4 weeks. All right, sign up today. We'll see you on Sunday at our webinars. You guys have a fantastic week. Trade safe, trade like a trade pro, and keep an eye out for the upcoming week. Some of the political tensions from Ukraine and Russia, and some of the resistance levels that are in play on the S&P 500. All right, make sure you have as much info as possible, and that's how you trade like a trade pro. Thanks a bunch for watching Market Roundup. Have a stellar day. We'll talk to you soon.